Haibin Zhu is JPMorgan's chief China economist, and Ronald Wan is managing director for China Merchant Security. And he joins Zeb and Mia and myself, and I'm going to ask you to start things off, because I've talked.
You've talked enough on this Friday here. Okay. Well, my question for both of you guys is, clearly this is going to put pressure for Chinese banks. Those lenders are going to take a huge hit because essentially this is going to squeeze their net interest margins. Can you comment a little bit about how these banks, these Chinese lenders, are going to act, and what is their game strategy going into the second half of this year?
I mean first?
Yeah, okay.
It's for both of you. Kick it off for us. Go ahead.
Although this time is called the symmetric cut, but remember that the second most important part is that they allow for the bigger interest rate flexibility, so the banks can charge
and a discount.
offer premium.
They can charge a discount on this as well now, so that helps them.
But in practice, very likely the premium on the deposit rate might happen, but the discount probably may not happen that much. So basically, we're talking about the shrinking net interest margin for the banking system, and that will be negative for the Chinese banks in the near term.
Ronald?
Yes, that will be a negative impact on the Chinese bank, but that is also an important step for the liberalization of interest rate in China, so that it happens anyway, anytime. So, but at this time, it's very bad for the Chinese banks. So we have seen the share price has dropped quite significantly today.
That's a great point, because this is going to eat into the share price ultimately, right?
Let's talk interest rate liberalization, because, Ronald, I'm curious, what does this tell us about the psychology of the Chinese leadership right now, the fact that they've moved so swiftly ahead of this data this weekend?
I think the key important economic data will be announced tomorrow, and the interest rate cut actually happens 2 days before. It means that the data may be showing a worsening economy of the
everybody's been saying that. It just says that it's not going to be particularly good news on Saturday.
And so it actually gives the market some sort of a warning before, so that when the figures actually come out, and the investor won't be alarmed or won't be affected too much.
But Ronald, if I'm correct, I think you thought it was going to happen sometime in the July time frame, right after these Greek elections, and perhaps after the G20 meeting that's going to take place on the 18th to the 19th of this month.
Yes, we actually had a discussion 2 weeks ago, is that we predict the interest rate cut to be in July, but actually it comes much earlier than we have expected. So
but you can't predict it, that's one thing for sure, isn't that the case, Zhu?
I think from positive side, it signals the change in the policy stance. So if you think about the past 5 months, the PBC move has already been behind the market expectations. So it come after the disappointing data, and this time it comes moving ahead of data release. So
do you think so? Well, just because it's out tomorrow. Because a load of weakness.
Getting out ahead of the news, the bad news, perhaps.
Well, it really seems now to be the case that the Chinese government really has 3 things under their belt, right? They can move what's going on the monetary front, they can move what's going on the fiscal front, but I haven't really heard too much of what's going to happen in terms of opening up various sectors to private investment. Can you comment a little bit about your thoughts on what the government can do on that front?
Well, actually, I think the Chinese government is liberalizing the private investment to be channeling the funds into the banking sectors. Regarding other sectors, I think it may be in the pipeline and will be announced in the next few weeks or months.
Okay, what about, when we get the new leadership in place as well, will that be more friendly towards private enterprise, also foreign private enterprise as well?
Yeah, I think that's a new trend, which is different from the 2008 and 2009 stimulus. At that time, the public investment dominates, and this time the new phenomenon we're talking about is the opening access to private capital, which means that private sector may take this opportunity to expand in this economic comeback.
Yes, I think it's part of the restructuring of the Chinese economy as well, and to channel the excessive funds in the private sector into the economy.
So does China now have to get used to, I guess, 6% growth rather than 10, 11% growth? And we talked a little bit about that, didn't we? But what about you, Ron? I mean, what is your view on that?
I think 6% or 7% growth will be something like classified as hard landing in Chinese terms. But anyway, I think the economy will slow down to something like 7.5%. As long as the economy can be restructured and in a good way, I think the investors or even the people in China have to accept the growth rate, which is slower.
So have you already recalculated your second quarter GDP figure, or are you going to wait till after tomorrow?
We have to wait for the figures first.
I think it's probably wise to wait till tomorrow.
And it seems like analysts were constantly changing their numbers, right?
They've acted with great speed, and I guess the question now is what's next? Briefly, what's next?
In terms of policy?
Yes.
Yeah, okay. We expect the more fiscal policy to really happen in practice. Because so far we have heard news say the projects have been approved, but next step is basically allocating money into the projects and get the project really started. And that's important for the economic comeback.
Got it.
Thanks, guys. Thank you very much indeed for joining us there. Ronald Wan from China Merchants Securities and Haibin Zhu there from JPMorgan.